So let's decode profitability or profit. So it would always start with the sales. And remember, we are understanding profit or profitability not from the perspective of financial reporting. Of course, this is also useful in case of financial reporting as well, but we are understanding because we, as the member of the board of directors of different companies, have a different role to play, and therefore our understanding of profit has to be from a different perspective, and that is what we are doing. So, how do we start this? So, you start with the figure of sales, right? And let's say, for the sake of example, that this sales that we are talking about is 1000. It doesn't really matter, we can take any amount, but our objective at this point in time is to understand the entire process, and therefore we take this figure as 1000. Now this sales, friends, is also known as top line, is also known as top line. And why it is also known as top line? No rocket science. As you can see, the figure of sales is appearing on the top of this statement. It is the top line in the statement, and that is why it is also referred as top line. Meaning what? Meaning, if someone is asking you as to how is the top line of Tata Steel, or how is the top line of Aditya Birla, or how is the top line of Vedanta, obviously what they are referring to, they are referring to as to how much the sales of these companies. Now from the sales, what do we do? From the sales, we deduct the first cost that we incur in a business. And I'm sure all of us know the first cost that we incur in any business. And our focus at this point in time is from the perspective of manufacturing, because that is the dominating sector as far as the economy is concerned, if the industry is concerned, and therefore we are looking from that perspective. So what do we do? From the figure of sales, we deduct the first cost that we incur, and the first cost that we incur is the material cost, and let's say that amount is 300. So that is the one thing that we do. Now what we do? Now we deduct the second cost. And what is the second cost? We all understand it very, very easily. The second cost that we incur in any business is the manufacturing cost. And let's say that amount is 100. And so what do we do? From the figure of my sales, I deduct both these costs, that is the material cost and also the manufacturing cost. What do I get in my hand is gross profit, is gross profit. Now please remember, friends, before I explain that further to you, this manufacturing cost is also known as conversion cost. And why it is known as a conversion cost? No rocket science. It is known as a conversion cost because manufacturing cost is the cost that you incur for converting the raw material into the finished product, and that is why manufacturing cost is also known by conversion cost. So both these costs put together are also known as COGS, right? So what is cost of goods sold? The question may come to our mind. So cost of goods sold is nothing but the total of material cost and the manufacturing expenses put together, and that is your COGS. By the way, friends, now that we are operating on very senior levels in our respective organizations, I can also give you a little more extra explanation, and that is only for your understanding. Really speaking, this is not COGS. Really speaking, this is cost of goods produced, because cost of goods sold will also include the cost that you incur on the selling of the product. But globally, I have seen, having delivered my program in more than 50 locations across the globe for ArcelorMittal and Aparam, these costs, these two components put together, globally are referred as COGS, not COGP. Actually, really speaking, this should be referred as cost of goods produced, but that is only for your extra understanding, right? Now, from the sales, when you minus these two components, what you get in your hand is your gross profit. And please remember, this gross profit is also known by different names. So some people will call it as gross margin. Some people will call it as gross profit margin. Some people will call it as gross value addition. Somebody will simply say value addition. And somebody will say gross contribution. Please remember, they all mean the same thing. They all mean the same thing. Right. Now what do you do? So having arrived at the figure of gross profit, what do you do? Now you deduct your third operating cost. And what is your third operating cost? Your third operating cost is known as SG&A, selling, general and administrative expenses. So everything else other than the raw material cost, other than the manufacturing cost, will be part of your selling, general and administrative expenses. So let us say that figure here is 100, and so now what we have? Now what we have is 600. That is our, so now what we have is let's say SG&A 100, and so your gross profit minus your SG&A, and what we get in our hand is known as EBITDA. EBITDA is your earning before interest, tax, depreciation and amortization. Now please remember, EBITDA is also known as cash operating profit. Is also known as cash operating profit. Now here I would like to give you three questions, and I would like all of you to answer these three questions. And that is because I'm sure all of you in last 10, 15, 20 years must have heard this term EBITDA at least a million times, because every time you open a newspaper on business or economics, every time you open a channel on business markets, you would see this term EBITDA. And I'm sure in internally within your respective organizations also, whenever you are sitting in the meetings of the top management or the operating management, you would hear this term EBITDA very, very often. So I would like to leave you here with three questions, and I would like all of you to respond to those three questions, and then we will discuss it further.